All right, let's tackle a huge question today, one that affects every single one of us, but can feel, a little out of reach. When we talk about the government's budget, where on earth does all that money actually come from? I mean, seriously, think about it for a second. We're talking about roads, schools, national defense, healthcare. All of it costs an unbelievable amount of money. So how does the government actually fill up its coffers to pay for everything? Well, that's exactly what we're going to break down. Okay, so this flowchart right here is going to be our guide. Now, I know it might look a little complicated at first glance, but trust me, it lays out every single source of government income. And we're just going to walk through it step by step. It's actually pretty simple. So, right at the very top, you can see the first major split. All the money a government takes in, what they call receipts, falls into one of two big buckets: revenue receipts and capital receipts. You can think of it like your own money. You have your regular salary that comes in every month, and then maybe, just maybe, you get a one-time bit of cash from selling your old car. Both are income, right? But they're fundamentally different. And this really nails the difference. So revenue receipts are the government's steady, predictable income. It's like its paycheck. It's the money it can count on coming in again and again. Capital receipts, on the other hand, are the one-offs. These are irregular, and they usually happen when the government either sells something it owns or, importantly, takes on new debt. So one is routine, the other is a big, non-recurring event. So let's follow our roadmap down the first path and dig into the government's main income stream, those revenue receipts. This is the lifeblood, the money that flows in pretty consistently to fund the day-to-day operations of the country. And as you can see, this branch immediately splits again. And the first, and by far the most important part of that, is tax revenue. No surprise there, right? The key thing to understand about taxes is that they're compulsory payments. You don't pay your taxes and expect to get a specific service delivered to your door. Instead, we all pay into one giant collective pot that funds all the public services for everyone. But not all taxes are created equal. Tax revenue itself is split into two very different categories: direct taxes and indirect taxes. And the real difference between them boils down to that question right there: who really ends up paying? And here it is, laid out perfectly. With a direct tax, it's simple. The person or the company that gets the tax bill is the one who pays it. The liability, who has to pay, and the burden, who feels the financial hit, are on the same entity. But with an indirect tax, it's different. The business that sends the money to the government isn't the one who actually feels the pinch. They pass that cost, that burden, down the line. So let's look at some examples of direct tax. The one we all know, of course, is income tax, which we pay on what we earn. Then there's corporation tax, which companies pay on their profits. You've also got things like wealth taxes on assets or an estate duty when property is inherited. In every single one of these cases, the tax is aimed directly at the person or the company that's responsible for paying it. Now, indirect taxes, these are the ones we pay all the time without even really thinking about it, because they're just built into the price of stuff. This includes things like customs duty on imported goods or excise duty on specific things like gasoline or alcohol. The best example is just a regular sales tax or VAT. When you buy something, the store owner is the one who collects that tax and sends it to the government. But you, the customer, are the one who actually bears the cost. The burden got passed on to you. Okay, let's backtrack up our flowchart for a second. We're still under that big heading of revenue receipts, the regular income, but there's another source that has nothing to do with taxes, and that, logically enough, is called non-tax revenue. This is kind of a catch-all for a bunch of different income streams. It includes things like interest the government earns on loans it's made, or profits and dividends it gets from companies it owns. It's also all those fees you pay for government services, like getting a passport, or even fines for breaking the law. It's a whole collection of different but still recurring ways the government makes money. So, we've now explored the entire left side of our map. That's the government's whole regular paycheck, from income taxes all the way to passport fees. But that's only one side of the story. What happens when all of that regular income just isn't enough? And that brings us over to the other side of the chart, capital receipts. And as a reminder, this is the non-recurring one-off income. It is absolutely crucial to remember that this kind of money always comes with a string attached. It either creates a new debt that has to be paid back, or it comes from selling off an asset that the government owns. So here are the main ways this happens. Recovery of loans is when the government gets paid back on a big loan it gave out in the past. Disinvestment is a fancy word for when the government sells its shares in a public company, getting a lump sum of cash but reducing its ownership. And borrowings, well, That's pretty straightforward. That's the government taking out loans, whether from its own citizens, its central bank, or even from other countries. Each of these is a big one-time cash injection, and each one fundamentally changes the government's balance sheet. Okay, so let's zoom out and just take a look at the entire picture we've just built together. We started at the very top with all government income, and we followed every single branch all the way down to its source. From the little bit of income tax you pay to a massive international loan, it all fits right into this structure. So if you only take away three things from all of this, let it be these. First, that huge split between the regular, recurring revenue and the one-off capital income. Second, that the regular revenue comes from both taxes and other non-tax sources. And finally, that really important difference between direct taxes, which you pay yourself, and indirect taxes, which get passed on to you. And that really leaves us with one final big question to think about. Now that you see the whole framework, what do you think the balance between all these different income sources says about a country's economic health? For instance, is a government that relies heavily on borrowing and selling assets in the same shape as one that funds itself mostly through tax revenue? It's definitely something to chew on. Thanks for tuning in.